I'll talk a little bit of calendar, say just a reminder, not a week, next Tuesday, July 7th, we'll start our 3-week calendar boot camp. As you click on that on the front page of Sheridan Mentoring, you get Sergeant, who was that from Gomer Pyle? Do you guys remember Gomer Pyle? Who was the drill sergeant who was always in Gomer Pyle's face? Anybody remember that? You're all probably so young. Most of you are in your 20s or 30s. Carter. Yes, Sergeant Carter. Remember him. So this is a free webinar we did last week. The boot camp starts, it's $297, starts this coming Tuesday. It'll go 1 p.m. Central for Tuesdays and Thursdays for 3 weeks. There's a little more information on it. And I'm doing this class because this has been our probably one of the more, if not the most, but one of the more effective strategies for income trading in the Sheridan community over the last 3 months. And you would think, but it doesn't seem to mix with the high volatilities. The calendars would be good, but they've been great. And so they're continuing to be good in this historically high volatility environment. And so we're going to focus on that for 3 weeks. And whether you're a beginner, intermediate, or advanced, if you're a beginner, we're doing lots of live trades, step by step. If you're advanced, you're going to get a lot of tweaks that maybe you haven't thought of. And we'll be talking about adjustments. So it'll be more shorter term calendars, but that should be a great class. Jay Bailey and Mark Fenton will be helping me with that. And if you're looking to get one strategy that you get consistent with, this would be a great one. I think is a great complementary strategy to the credit spreads that we did, credit spread class. All right. With that being said, let's look at a calendar. First, let's take a look at the market. And as we look at SPX, again, it's been a good week for the market. You know, if you look at the last, month or so, you know, we've just come from the lower, last month or two, we've been in the lower end of the range, and we just worked our way up towards the upper end of the last 1 or 2 month range. You know, we're still, 7 or 8% off the highs that we reached in Feb, but, you know, pretty normal. We were in the, as I said, the lower end of this range, worked our way up. VIX right now is definitely in the lower end of the range over the last 3 months. VIX is 2679, and we haven't been much at VIX 24 to 26 over the last 3 months. And so we're back down there. Usually as you can see, as the market goes up, VIX will go down, right? So basically the range over the last 3 months, more or less, so the range we've been going by is 24 to 26 on the low end, and VIX on the high end 40. And so now as of today, we're at 2674 right now, and with SPX at 3145. Are we in an uptrend in the market? Yes or no? Are we in an uptrend? Yes or no? Are we in an uptrend? Yeah. We're above the 200. We're moving up. What would be my best guess on the market in the next 2 months? A range, right? I think, again, I think the Corona and everything else is a process. It's not a normal correction. And I think we'll be in a bit of a range. I think it'll be good for income trading. There'll be bumps along the way, but that's what a higher volatility environment is. And so in a way, if you look at the market we're in the last month or two, I'd say this is a range. But you might say, you know, Dan, it is a range, but boy, you get some big candles, it's more choppy. Well, but it's all relative, right? If you look at comparing maybe November, or you look at the range in November or whatever before the whole Corona thing, boy, very nice range, but very low VIX, right? Maybe 15. And so what would you rather have? This type of range for range bound trades or income trading, very range bound at a 15 VIX or closer to a 30 VIX, and it's range bound. I like more premium. And so, this isn't bad, and it's getting a little bit used to. But again, I think it'll continue to be a good income environment, I think the rest of the year. But, again, just like, whether we didn't have the Corona or not, there's always bumps in the market. But I think, again, we're in this range. Over the last couple months, the high has been, 33, 30 or somewhere around there. So we'll see. I could be wrong. Let's take a guess here. How many people think in the next 2 months that will hit the highs of 33.93? How many people think in the next 2 to 3 months will hit the highs? Yes or no? A little more skeptical bunch. Some yeses, some nos. I don't know, right? My guess would be in the next 2 months, no. But I still think, again, to be successful in the income trades, calendars, butterflies, etc., you just need some type of a range. So 80% of the time we're going to be in, right? Right? All of this is good for income trading. All of this is good for income trading. It's just when we're moving, when we get these moves, those are the only time we're really not doing that much income trading, so it's not that often. And let me ask you, are these things you can see? Yes or no? Are these things you can see? Like right now, we're trading. How can we feel comfortable that we're not going to get one of these or one of these? Does that bother you how many does that bother you from putting consistent income trades on? The fact that we could go whoop or whoop. How many does that bother you? How many does that bother you that, hey, Dan, I'd like to put consistent income trades on every week or month, but boy, it bothers me and market's crazy. What do you think is a reason why we're going to go full throttle on income trades, even with the possibility of this or this? Either we're crazy or what? What do you think? So here's why. So why do I think you can continue with range-bound trades? Here's the answer. Right? I have a plan, yeah, but let me ask you a question. If you're, again, going to my analogies, risk management is key, absolutely. But let me ask you a question. If I said to you, you're in, you're driving in Chicago, drive 60 miles an hour on the highway, 70 miles all the time. But when you get up to 7 inches of snow, go down to 50. Are we allowed to do that? Are we allowed to say for surfers in Huntington Beach, California, waves are 4'5", surf every day of the year except 2 indicators? If there's shark alerts or if the waves go over 10 feet. In other words, am I constitutionally able to stop doing my income trades whenever I want to? Yes or no? constitutionally, I checked with a constitutional lawyer before this session, and he says, even though we're doing income spreads full throttle, we can stop when we want. So the answer is, when would we stop? A couple things. So what we're talking is, obviously, if I have a trade on today, right? Unless I had insurance, if I had a trade on today and Monday we opened down 1,000, right? That's one thing. But I could open down 1,000. But my point is, what am I looking for? When would be? So again, going back up to the correction, right? We were doing income trades full throttle, foot on the gas, as we went up to Niagara Falls. Were we concerned? Yeah, we were concerned, but what was the plan? The plan was, if VIX hit 18 and ATR, which measures the width of these candles, right? We're concerned if the ranges get too big. If the ATR and SPX hit 27 or higher, right? We don't put anything on, right? And if any of the moving averages, simple things, right, were busted, right? And right at the beginning here, VIX hit 18 and ATR hit 27. So what were we saying? The waves got too high, too much snow, pull off the side of the road, and waiting for a range to develop. So as we were going down and waiting for a range to develop, no. Waiting for a range to develop, no. The ATR is still waiting for a range, no. It took a while, right? But it kept us out of the water. Now, for the few trades we had on, right, when we see that happen, we just say BASP, buy a stinking put, as when you get in that volatile environment. And if you adjust your position by buying a put and the market goes down 200 million billion trillion points, you're okay. Now, how many puts should one buy? Well, it has to do with your position. If we're like here, when we were going down, right, if someone was 10 deltas long on a calendar and they bought a 10 delta put, right, that's what you'd buy. If I'm 10 deltas long and we're going down, I wouldn't buy a 30 delta put. Well, unless I knew it was going down more. But the point is, anybody who bought a put against any of their positions up here made a lot of money, right? So there's no ratio. How many puts should one buy, right? If you're 10 deltas long, you buy one put at 10 deltas. So what puts you buy is what your position deltas, right? That will determine what you buy. But the point is, in the market now, what would bother me, right? As we look at the market here, you can kind of see the range here, all right? So full throttle income trades. What would, on the downside, let's make a list. What would cause me to back off on the downside? Let's make a list of things. The 200-day, they go through that, right? I have a list of things. Number one, we break through the 200. Number two, VIX greater than 40. Number three, so these are all avoiding some of the range bound trades. Number three, if I look at the ATR, right? ATR right now is 59, right? I'd say ATR gets greater than 80. So in other words, if I'm alive and my eyeballs work, right, I've got points there, right? What are these for? These would be for when I would back off some of the range-bound income trades. Why would you back off? Get ready for this answer, because we wouldn't be in a range anymore. Ha ha, ha ha. Agree? Right? As this is happening, is this called a range? No. Right? And it took a while. And we're coming out of this correction a bit. But now we're in a range. Now on the upside, you know, you could say it's a little different. You know, somewhere between, you know, I guess the first level would be, I would just put the first level to maybe start looking would be the previous highs, right? And then after that, maybe the all-time high. But all we're saying is, for the income part of the portfolio, calendars, butterflies, double diagonals, double calendars, this range-bound delta neutral butterflies, what do we want? Some type of a range. Are we going to be in 80% of the time? Yes. When aren't we going to be in? When we're not trending, right? And so we're just watching the waves here. Again, we're focusing on, you know, for doing range-bound trades, I'm much more interested in the last month or two than I am 7 months before. Does everybody get an understanding of that? It's not that I think we make things more difficult. But here's the thing. Not once did I say China. Not once did I say COVID. Not once did I say the NBA basketball season. Not once did I say the Fed. Not once did I say whatever. Because as someone who plays this game of options called Pac-Man, is most of this stuff in the market? Yes or no? Is most of all this stuff that we spend hours and hours a day reading baked in the market? I'm going to tell you something. Promise you won't tell anybody. All right? I'm going to tell you something. Promise me you won't tell anybody. 80% of the market makers, and these are the best options traders in the world, they didn't give two hoots most of the time about news. When they came in the morning, now you would be aware of stuff, right? Let me tell you something. There were stocks that I was trading options on, thousands of contracts a day. If you asked me specifically what they make and all this, I had no stinking idea. I don't care. I'm not promoting ignorance, but I'm saying I'm playing this options game. The key thing is this: options traders who had to make a living, who had to cover a big overhead, who had to do this, they were only going to focus on the stuff that had to do with making money. If paying attention to CNN and CNBC and spending 6 hours a day reading, watching the internet would help their trading, trust me, they'd do it. But you know what? Where they spent their time? Working on the craft, understanding the strategies, understanding volatility, making their decisions based on volatility in the price. That's what they did. Now, again, technical analysis isn't bad, but you know, in the retail community, you guys spend 80% of your, here's my, all right, this is called Thursday Armchair with Dan is events. And then we'll get into calendars. This is my last comment. If you ask me to summarize retail traders, 80% of their time, they spend a lot of time looking at news and technicals. 20% of the time working on the craft and the options. Market makers or professional option traders spend 80% of their time on their strategies, the craft, risk management, the plan, all that stuff. 20% of the time on, I don't want to call it nonsense, but I'll call it nonsense. Technical, again, technicals, news, and all that. I think technicals has its place, right? We talk technicals in our community, but it ain't number one, it ain't number two, and it ain't number three. It's what's your plan, risk management, but understanding the volatilities and putting this stuff on. Anyways, that's my 2 cents. And it's, you know, and again, is that hard for retail customers? Yeah, because let's face it, when you guys go and you look at all the stuff on the web, option educators, futures educators, all the education, is 80% that's taught out there taught on the assumption of your opinion or which way the market's going? Is 80% of the stuff out there generated from unusual option volume or where the market's going or technicals? And I think it's a bunch of hooey, right? Right? Overall, I'm talking about a long term. Your focus should be, if you want to be a great option trader and get consistent, 80% of your time should be on options and volatilities and risk management and making a plan. 20% on the hooey, right? The news and the technicals. Yeah, and really, as Robert said, he saw a film with Tudor Jones. He said that every investor should focus on what they can lose and they would be successful. I worked with, for many years, John and Pete Nigerian, who, you guys ever see them? Those are the two guys with lots of hair on CNBC. Do you know what I'm talking about? Fast Money. Those are the two guys with a lot of hair. Just being joking. I love John and Pete. But the point is, in the mornings, we would have a 1-hour meeting every morning, go over our positions. Very seldom did we talk about technicals or the news. That would be very little of the conversation, 20%. We did, but it was 20%. The rest of the time this is what we discussed for 20 years in the meetings. What's our position? Where do we get hurt? What's the volatilities? Do you want to be more sellers of options or buyer? Based on the volatilities and the price levels, what should we be doing? Where's the edge? What volatilities are, what strikes are higher volatility than the others? What should we be doing? What if it goes up? What are we going to do? What if it goes down? What are we going to do? Should we put more capital into the trade? What would determine if we put more capital into the trade? Is it a better than unusual, better than normal opportunity? That's all we were talking about. What if this happens? What if this? And we'd say, okay, what if the market? And then part of my job would be once a week we would do, well, what if the market did something unusual and went down 10% or up 10%? How much would we lose? Okay, we lose $2 million. Is that acceptable? Yes or no? If it's not acceptable, let's go buy some insurance. So we were looking, again, is it wrong to talk about news and technicals? No. But that didn't dominate our hour meeting. Petru says, how come one man like Jerome Powell can control the whole market? He's saying the market must go up and millions of people follow like sheep. Well, I don't believe Jerome Powell is controlling the whole market, right? Again, ultimately, demand and supply control the market, right? And again, focus on what you can control. I don't care who's the head of the Fed. I don't care what they do. We're playing this game. When Petru plays Pac-Man, right? He doesn't know which ones are going to come out and go to the left or which ones are going to go. He doesn't know where they're going to go. But how does he get good at it? He's focused, so he doesn't know that, right? So he just gets better at Pac-Man by being good at the craft, right? I don't know what Powell's going to do, and that shouldn't be my focus, right? Anyways, enough of my ranting. What do I encourage you guys to do? Learn the craft. Put these, do similar strategies all the time. So let's look at a calendar for today. So here would be a 15-day calendar, July 17 expiration. And again, we have some very low levels in VIX right now. So here'd be an example where I'm selling the July 17 and buying the July 24 at the 31.50 strike. So here's a calendar. So this is a 15-day calendar, right? And we've got about, we're doing it at the 3150 strike. And we're around 3151. So doing an at the money calendar. Our expiration break even. See, I look at this as a little game, right? If I was explaining this to a fourth grader, I wouldn't even call it a calendar, right? I would say, look, we're putting this thing on at 3150 or whatever. In this area, expiration break evens, this trade makes money, right? It makes money. This would be 3090. It makes money between 3090 and 3210, right? So as we're between this area, 60 points up or down, leave it alone and let it percolate like a good cup of Folgers coffee. Because in that range, we're buying a July 24, 3150. And we're selling one July 17, 3150 call. So our long is 7 days further out than our shorts. Our short is 15 days out. I call it a 15-day calendar. And this is going for around, this particular calendar, I'm just rounding it, around 13 bucks, so $1,300. And you're saying between your expiration break evens, your green line here is your graph in 15 days. That's the expiration line. Your purple line is your graph of the trade today. Over the next 15 days, this purple line will morph into the green line. But between 3090 and 3210, this purple graph will get higher and higher and higher, and you'll make more money if we stay between here. If we go outside of these areas, we would lose, right? We would start losing. So I would tell the fifth grader, look at, play this game between 3090 and 3210, leave it alone. And if you pay 13, as it stays in this range, this is a 15-day trade. Over the next 4 or 5 days, this 13 will grow to 14 or 15. If we go outside of this range, under 3090 or 3210, the trade will shrink to 12 or 11. So stay inside the 10, right? Is the basics of it, right? The basics. Now, they call it a calendar. I don't know why they call it a calendar, right? It'd probably be better, as Jim said, maybe call it a circus tent or call it an igloo, or if you put an eyeball on it, like a shark coming out of the water or something. I don't know, whatever you want to call it. But it's a delta neutral trade that has about $20 of theta a day on a $1,300 investment. And this theta gets bigger every day. On a 15-day trade, I'd probably be looking to stay in the trade no more than 4 days. But that's the calendar. And where the VIX is today, like 26 and a half. So at 26 and a half, we're getting about 60 points break even from the strike. If the VIX were 30 or 31, we're getting closer to maybe 90 points. Now, do you want wider break evens? Yeah. But that would give us higher volatility. Do we want higher volatility with a calendar? Not really. So, you know, obviously this is just the basics of it. There's a lot of, you know, a lot of the questions that we're going to deal with in the calendar boot camp is, you know, what's the ideal duration of the short? When do you go 7 days out? When do you go 15 days out? When do you go 30? Do you put 3 days distance between the long and the short, 7 days distance between the long and the short? Do you put 60 days difference between the long and the short? When do you not trade a calendar? When do you back off of a calendar? When do you trade less size? And then, get into the risk management. What would be a profit target? What would be a max loss? When do you how do you adjust it? And again, dealing with short-term trades, the boot camp will be dealing with, I would say 4 to 17-day calendars. What are the most important considerations? So really what we're going to work at is the craft part, right? The craft part. When does Vega start hurting? Vega talks about what does this number mean? It says we're long 52 Vega. What does that mean in English, Spanish, or Portuguese? It means if the volatility of our long option goes down a point and our short option goes down a point, theoretically we'd lose 52 bucks. If the volatility of our long goes up a point and our short goes up a point, if it goes up a point each, we make 52. If it goes down a point, we lose 52. So if the question is when does Vega start hurting, generally the answer would be when the volatility goes down, right? Another thing calendars will talk a lot more about, you can see here our long option is a 20.26, our short is a 19.31. So they're not the same. They're different numbers. In this case, this is called a negative skew, when the volatility of our long option is more than the volatility of our shorts. Is that good or bad? They have a negative skew, meaning the volatility of your long option is higher than your short. Does that seem to make sense? Buy high volatility, sell low? Is that good to have a negative skew? In an uptrending market, a negative skew is normal, right? Most of the time in an uptrending market, you'll see negative skews. It's a normal, it's not bad. And as you trade calendars, you get more used to the skews. Petru says, is better to have positive skew? No, it's not bad. I mean, it'd be good to have positive skews if there was no reason why they were positive skews. Like, for example, earnings are coming up in July, right? So the expiration that's going to be affected by earnings will be the highest. Should we sell that? No, you can do a lot of positive skew calendars around earnings. Does that make them good? No. Why do you have positive skew? Because the reason your short option is higher than your long is because there's some type of event coming up. And that's why people are willing to pay more for the volatility of the expiration of your short. So it's generally, I wouldn't say it's generally not better to have a positive skew. It's alluring, isn't it? But it's not better. Anyways. Well, so again, like in anything else, we recommend when you trade calendars, as I was talking to somebody today, it's important to track your trades, but it's, how do you grow as a trader? You grow as a trader by, like, every time I do a calendar, I'll write down what was the day I put it on, what time, what was the price of SPX when I put it on, what was the volatility of my long option, what was my short, what was SPX trading at, how much was it up or down for the day, what was VIX trading at when I did the trade in SPX, up or down for the day. So I've got all this information, so as we move forward, I can compare this. But I'm interested in the volatility of my long and my short, and I write down my Greeks at the beginning of the trade. let me give you one example. Here would be a, let's just say we look at, I mean, we can pick a stock, but let's say we look at Apple. If you look at Apple, Apple's going to have earnings. Let's see. Apple will be having earnings. When will Apple be having earnings? Let's see here. Well, this one isn't clear to me. July 31st. Oh yeah, I'm sorry. Thank you. Yeah, you can see this. So if you look here, here's the at the money strikes in the calls, the different expirations. So how do you know when earnings is going to fall? Look for the jump in volatility here. 21, 25. Well, this would be the same. What you see here, whoop, and then it kind of levels off. So earnings are going to be this expiration, the week of Friday, July 31st. And as gentleman mentioned, July 31st. So you could see here, if I wanted to do, this is where the spike, takes place, right? It jumps up to 31, right? And those volatilities are high, right? We'd like to sell that high volatility, but it's up there for a reason, right? Anyways, so from a calendar point of view, I would be looking to do, we call these pre-earnings calendars, right? I might do something like this. I think I'll save this for another time because this wasn't really, the options boot camp that we're coming up is just going to focus on the type of calendars that we do in Sheridan Mentoring every day, where people have been good success at. The earnings calendars, maybe I'll save that for next week. I'll devote next week's free webinar just to trading earnings and these pre-earnings calendars instead of just dipping the toes in here because there's too much to explain. But I think it's important. Calendars, I think it's a terrific strategy, and I would encourage you to sign up for the class. Again, it starts next week, and we're really getting to get into the minute details and trade these things. I don't normally do calendars as we're going over the weekend on a 3-day weekend. But if you just look, going back to the SPX real quick, and I'll let you guys go, would I put a calendar on today? I might put one on small. I mean, it wouldn't be my first choice, but if you look at the 3150 where we're at the money, if we had can this position, if we put it on at the money, let's say this is the end of the day, and we center it at the money 3150, and our break evens are about 60 points away, can we handle a 50-point move up or down? Yes or no? Can we handle a 50-point gap Monday morning? Yeah, right? But if we were, so here's the strike we're putting it on, so the calendar is well centered. Here's where we're trading at. So I wouldn't mind putting one on as long as we're well centered and I can handle 50, 60 points either way. Now, at the end of the day, if we were here or here, would I go over the weekend or would I put? No. because wouldn't have 50 points that way. Or up here, I wouldn't have 50 points, right? So again, am I a big proponent on putting calendars on over the weekend? No. What would be a reason I might consider it today? Well, VIX is 2685, down 1.77. It's on the low end of the range. So because the vols are cheaper, I might consider it at the money, doing a little bit, but not my normal size. But again, anyways, so those are things, just get you thinking calendars. Again, I want to encourage you, if you really want to get into the work in the craft, again, we'll meet Tuesday and Thursday starting next week, and we'll go for 3 weeks, 6 classes. Every class will put a live trade on so you can get practice with it. And trade it from beginning to end. So it should be very thorough. All right, folks, have a wonderful holiday and have a great weekend. We'll see you later. Thanks.